When goods are insured, some kinds of insurance documents will be issued by the shipping company to the insured to certify the insurance contract between them. But the insured buys not the contract, but the right to the sum of money and its future delivery. The insurer, on its part, promises to pay a sum of money, provided, of course, the insured keeps its part of a promise of paying the installments of the premium as scheduled. In international marine cargo insurance market, insurance policy and insurance certificate are the major documents available. An insurance company gets the details of the shipment from the policyholder and prepares his insurance policy offer. If the insurance holder agrees on the terms and conditions as well as the insurance premium, then the insurance company or the underwriter issues the insurance policy. Insurance policy is a detailed and legally binding written document, just like a bill of lading, stating terms and conditions of carriage as a transport document. Insurance policy defines the terms and conditions of the insurance contract and serves as a legal evidence of the insurance agreement. Every insurance policy has 5 parts: declarations, insuring agreements, definitions, exclusions, and conditions. Many policies contain a 6th part, endorsements. The insurance policy may be either a specific policy or an open policy. A specific policy covers a particular shipment or one shipment only, whereas an open policy, also referred to as open cover, is issued once by the insurer under the contract to cover many shipments made by the exporter to different importers over a period of time. Under the open policy, individual successive shipments are periodically reported or declared to the insurer and automatically covered on or after the inception date. Open policies can provide efficiency and savings for all parties concerned, especially when the insured conducts a significant volume of highly similar transactions. A great volume in exports business prefers this method. They do not like to make insurance for each shipment separately, but they sign an insurance cover for a certain period of time, such as 1 year. During the insurance period, exporters' all shipments will be covered with a cargo insurance. However, the exporter holding an open policy cannot send the sole policy to all the importers. Instead, he needs an insurance document for a specific shipment. Then, insurance company issues an insurance certificate, and which will bear the open policy number. Different from the insurance policy, an insurance certificate does not set out the terms and conditions of insurance. It is not issued as a standalone insurance document for a specific shipment, but they are issued under an open cover. It is also known as cover note. The most important difference between insurance policy and insurance certificate occurs on the letter of credit payments. According to LC rules, an insurance policy is acceptable in place of an insurance certificate or a declaration under an open cover. But the reverse situation is not valid. If the LC requires an insurance certificate, an insurance policy presented is acceptable. But if the LC requires an insurance policy, an insurance certificate presented is not acceptable unless the LC provides that an insurance certificate issued under an open policy is acceptable. Both insurance policy and insurance certificate should be issued by an insurance company or an underwriter and state identical information such as insurance terms and additional risks covered, amount of insurance premium, currency of the insurance cover amount, insurance company's agent at the port of destination, procedures for the claim and the required documents, shipment details such as port of loading, port of discharge, vessel name and voyage number, description of goods, etc. When it comes to the amount covered, in some occasions, insurance cargo policies indicate that the cover is subject to a franchise or excess deductible. Deductible is the amount that an insurer will deduct from the loss before paying up to policy limits. In simpler terms, when you insure your goods, the basic premises is that the deductible is the amount that will be subtracted from the total damage that occurs. The responsibility of the insurance company is to cover the remaining balance. Franchise deductible is a stipulation that no claim will be paid until a loss exceeds a fixed amount. Sometimes it can also be a percentage of the amount of insurance. Thus, the insurance policy covers the damage over amount set. An insurer will not be liable for the damage that is below the limit, but once the damage exceeds the limit, the insurance company has to pay the loss in full. In other words, if the loss is greater than franchise deductible, the payment that the insurer has to make should be in full. Well, nothing is paid if the loss minus the ordinary deductible is less than the ordinary deductible. Supposing that the policy states that the franchise deductible is $100, the policyholder will pay for that out of pocket anytime he gets charged $100 or less. Only when it goes above $100 does the insurance company will financially intervene on the policyholder's behalf. However, once the amount exceeds that particular deductive, the policy will pay for everything up to policy's limit. An ordinary or standard deductive is different on the other hand. In a standard deductive, the insured must pay an amount as a deductible set by their contract before the insurer will contribute to claims of their rest amount. Say, you caused $800 worth of damage. If your deductible is $1,000, the insurance will not pay to cover the damage. If you had a $100 deductible, you'd pay $100 and then would be paid $700. There are various ways that a franchise deductible amount is determined. One way is that the parties agreed on a specific cash amount. They can base it on the industry, the business risks, and the current situation of the business market. They should clearly stipulate it in the franchise and the insurance policy. Some business owners, on the other hand, use the percentage method. The insurance company can negotiate this with the business owner. Of course, the risks, the policies, and the various other factors affecting the business and the business situation in general. Insurance documents are necessary to evidence the existence of an insurance contract. They stand as a proof of the contract between the insurer and the insured. When handling an insured event, knowing the details of these documents is very important, not only for exporters and importers, but also other foreign trade participants. That's the end for today. See you next time.